Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
So what's the state of the mysterious world of crypto now that you can jump in with an ETF? Sandy Kaul is head of digital asset and investor advisory services at Franklin Templeton. Our next guest, Gary Gensler kind of made it clear the regulatory approval of Bitcoin ETFs. That's no sort of implicit endorsement by the regulators. I imagine, though, that hasn't dampened any of the enthusiasm, has it?
No, it definitely has not. Record launch for an ETF. Over $3 billion in net new inflows into the products over the last just week.
And how do you view some of those inflows, though? I'm looking at Bloomberg data, BlackRock and Fidelity dominating in terms of flows, both north of $1 billion. I'm looking at least according to the terminal, Franklin Templeton closer to $50 million. So how does that play out?
Yeah, I think that it depends who your audience is out of the gate. Right now, you're seeing a lot of the direct, self-directed investors coming in and accessing this for their own personal portfolios. Moving these new products onto the wealth advisory platforms is going to take a few months as they do their due diligence, see how the new product works. And so there will be a slower buildup of assets in the discretionarily managed and in the professionally managed accounts. And I think you will see this continue to grow throughout the coming year. So kind of an out of the gate with the self-directed, and then over time you will start to see more of the advised assets having an allocation to Bitcoin in many of these portfolios.
What are your fees? Is there a fee war?
Well, our fees right now are zero, so I don't think you can beat that.
Well, you actually could, but I won't go into that.
Well, we believe that, we want these early investors who come alongside us in our new ETF offering to really get the 100% full benefit of movements in Bitcoin. We think we're coming up to an important period fundamentally in the Bitcoin market with the upcoming halving event, where the supply is going to tighten systematically. This happens through an algorithm, and it's coming right at a point where these new ETFs are creating demand in the marketplace. And we think it's going to be an exciting period for Bitcoin. So we want our investors to get the full benefit of any price movements that might result. And we're not taking any fee. We believe in the long-term nature of this opportunity, and we're willing to be in it for the long haul. So we're going to wait and take our fees later down the road as the product becomes more established.
I have a host of wacky questions. You guys have ESG offerings, I would imagine, right? Okay, so how does this conflict with that? Because in order to generate this stuff, you have to run computers which take gazillions of tons of electricity or gigawatts or whatever. That's sort of in direct conflict, I would imagine, with the environmental goals of the company.
Intuitively, it would seem to be. But what's been kind of very exciting about this is that a lot of clean energy launches have been held up because there has not been a clear use case for them. And what we're seeing is a lot of these Bitcoin miners that have relocated from Russia or from China are relocating into areas, and they are using clean energy incentives that are being offered by the government to build their mining facilities. So actually, it turns out that Bitcoin mining is starting to be a use case for introducing clean energy technology. And of course, not all Bitcoin miners are at that point, but we're seeing a very positive trend in this movement towards cleaner uses of energy for Bitcoin mining, which we think is a great thing to see.
And Sandy, you mentioned kind of taking the long-term view. Eric Balchunas, our Bloomberg Intelligence analyst, coined it the Cointucky Derby, which I'm a big fan of. I enjoy betting on horses. JT, I don't know about you. No? Little pun for you?
Well, I'll go back to my wacky questions, but it's just I go to the barber shop. That's topic du jour of people who can't afford to lose money and who don't know what they're talking about. I don't even know what a Bitcoin is. I can't explain it.
No, well, Sandy, I'm just wondering, the Cointucky Derby, use your pun, whatever pun you want. There are 9 new spot Bitcoin ETFs. How does the race for money impact kind of success and whether or not people are going to be pulling out of it?
Yeah, so I look at it this way. There's two sets of offerings that are coming to market through these 9, I think it's even 11. One set is coming from firms that have been digital natives and have kind of grown up in the crypto space. One set is coming from traditional asset management firms. I think Franklin Templeton is a little unique in that we're actually both, right? We have been active and operating in the digital crypto native space since 2017. We operating across 5 different public blockchains. We do our own node verification. We really understand and are a part of the ecosystem, create our own research on individual coins, including Bitcoin, and put together portfolios of multi-coin portfolios through separately managed accounts that we can work with investors to access. So we've been in this space for a long time and really understand it, yet we are also a 75-year-old asset manager who is trusted and who has been there for clients through many market regimes. So I think it's the coming together of the crypto natives and the traditional financial services, really epitomized by Franklin Templeton, that I think is creating the excitement about what's going to happen. And I don't know if it's going to be a derby and some aren't going to finish the race. I just think it's going to be a long race, right? It's a new asset class. Some of your questions are showing people have yet to kind of start to understand it. But once they do, I think it's hard not to get excited. I saw that in my own career. When I had my aha moment, it's like my eyes opened and I really saw this new opportunity and potential.
Sandy, this may be a dumb question. Bitcoin trades 24/7. If the token crashes on Saturday and Sunday, do I wake up Monday morning with a huge loss on my ETF?
Well, the good news for you is if the token crashes on a Saturday or Sunday, we've got portfolio managers and traders trading it on a Saturday and Sunday and working to keep the spread between the Bitcoin index and what's happening in the ETF in line. So we operate 24/7 in these markets, just like the markets operate. So it would be like any market. You know, if there's a move over the weekend, you'll see that move reflected. But the fact that the ETF is closed and the market is open isn't going to be a problem in this case because we're running a 24/7 trading desk around this.
You mentioned the next big step that includes derivatives with respect to Bitcoin.
That's a lot of people are looking already at derivatives. I think that, you know, building the education and understanding of the opportunity is more important as a next step than really thinking about the next product evolution. I think a lot of people have yet to really internalize. We've been in a period where we're used to platforms being the way of the economy. Network effects are built around platforms like Amazon or Uber or Airbnb. And now what we're seeing in the crypto domain is that we're seeing protocol-based networks, right, where anyone peer-to-peer can access it. Just like when you type HTTP into your browser, that's a protocol. Everyone in the world can use that to access the internet. And these networks that are being built, like Bitcoin, are protocols that anyone in the world can use and everyone can participate in. So it's different than a company owning the platform. This is all of us collectively owning these new networks. And this is a new way to access that ownership. So it's an education process. And I think that that's where the focus should be, to really help investors understand why this can be an important opportunity for their portfolio.
Sandy, I got to ask about the Franklin Templeton X profile. You've got laser eyes on Ben Franklin. I would say
she's not in the marketing department, just to make it clear.
I just wanted, some of the more
weird.
Absurd tweets that I've seen, even a tweet saying the lawyers won't let us or respond to comments, but we hear you posting about the 60/40 plus Bitcoin. What is the marketing plan? Like, what's going on?
Well, this is really, you know, as I said, we really are part of the crypto native ecosystem as well as being a traditional asset manager. And our analysts, interns, employees that are in the digital asset unit really understand what matters to people in that community. And the laser eyes was an important signal to them that we stand with them in believing in the future of Bitcoin.
All right, Sandy, thanks for stopping by. I appreciate it. Sandy Kaul, head of Digital Asset and Investor Advisory Services at Franklin Templeton. Did I sound too skeptical? Was I too harsh?
Talking to the youth.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Well, let's make a deal. What's the outlook for M&A in 2024, Bailey? Our next guest, Mitch Berlin. He's Vice Chair of America's Strategy and Transactions with Ernst & Young. And I got to say, I think he wins the prize for the coolest looking office on Zoom today. Are you like in a quest? What are all the ribbons in the background?
They're actually dog show ribbons.
Oh, dog show. Whoa, cool.
I'm even
now
more interested.
All
Yeah,
right, we've just changed. We've just changed the topic. So you're going to get in trouble from the company.
My dogs are more accomplished than I am. So,
what kind of dogs?
On their behalf.
What are the dogs?
Portuguese water dogs.
Oh, beautiful. Those are the ones that are like hypoallergenic. They don't shed.
Right.
Now I need
that is awful.
Portuguese.
Anyway, okay, so we'll get back on topic. Is this an environment right now in 2024 that's conducive to deal making, and kind of what's driving it?
It will be. So 2023 was a reset to the pre-pandemic deal volume. So if you look at major deals, those are those deals that are above 100 million. There were approximately 1,250 in 2019 and 1,250 in 2023. So we were trying to understand, what does M&A look like going from there now that we've reset to pre-pandemic levels? And so we looked at the last 35 years of M&A, and we correlated that to information such as GDP growth, inflation, corporate profits, the bond spreads and such. And we did see a correlation. And so if the predictions for those same metrics hold true going forward for 2024, we should see about a 12 to 13 increase in M&A over the 2023 numbers.
Does the feeling, I spend most of my day job, Mitch, covering the IPO market, and the main sense is that something's got to give. Is that kind of your sense? We have a need for deals. We have cash on the sidelines. We have companies who are kind of nearing the end of their maturity in one sense or another?
That's exactly right. I think that we're at a point now where people have been sitting on the sidelines for 2 years. There are a lot of private companies or portfolios or private equity that are coming to maturity on their debt to refinance. We put them in a very different position from an ROI than they are today. So they have to do the math and figure out, should we monetize now, or do we take the risk of refinancing, hoping that we can get a lower rate soon enough that it doesn't impact our ROI calculations?
Okay, so who's coming together in 2024? You don't have to name names, but that would be nice, but industries.
I can name the industry sectors. The sectors that we're going to see the most activity are the ones where the deal multiples have gone down, because in a time where you have a very high cost of capital and high multiples, it's unlikely that you're going to see a significant amount of M&A activity. But if you look at the sectors where the deal multiples have gone down, that includes life sciences and technology. Those deal multiples have gone down about 8 points each. And if you look at energy, those deal multiples have gone down about 4 points year over year. Those are the areas where
I thought energy was pretty much exhausted, like in 2023 with all those deals.
Well, there's still, and it may not be the major players, but there's still players out there, and their cost of, the cost of capital is high, but the multiples are going down, so they can be attractive targets.
When you're talking life sciences, we saw a number of deals coming out of JP Morgan a few weeks ago. Is that biotech? Are we seeing smaller bolt-on deals? Or are we going to see potentially the return of major M&A?
You're going to see both. I think when you look at major M&A, there are still patent cliffs looming, and they'll need to buy an R&D pipeline to continue to turn the profits that they want to turn. So I think you'll see it on both sides, and some of the smaller biotech deals as well.
What's up with the FTC and some of this antitrust, though? Is that something that's it feels like every deal has some kind of a tie-up? Just leave it at that.
Yeah, no, it's a good question. So the new guidelines came out. It's been 13 years or so since they've come up with since they've revised the guidelines. The clients that we're speaking to understand that it's going to make things a little bit more difficult and take longer, but they're not shying away from deal making, because in many cases they really don't have a choice. And so more will come under the radar, because the threshold of what they consider to be a movement in the consolidation index has tightened. So more will come under their radar. They're going to require more information, so the timeline to get a deal done is going to take longer. So more is going to come under their scrutiny. But we are working with clients every day to come up with multiple scenarios that they can look at around reshifting the portfolio of the combined entity into something that would be more appealing to the FTC and DOJ.
Okay, you want to weigh in on Spirit? I mean, what happened there? It's maybe not specifically, maybe a broader view.
Well, my guess is that the way that they shifted the portfolio and the routes may have not been exactly what the FTC is looking for, but it sounds like they're going back to the drawing board. From what we're reading in the paper, it sounds like they're going to go back for another try at it. So I imagine they're going to have to reshift their portfolio into something that's more appealing.
Well, looking at iRobot, that's coming from Europe. Are they more stringent typically? Like, what's to read from one of the biggest technology companies not being able to buy the maker of a robotic vacuum?
Yeah, so I can't speak on behalf of the FTC, but or the European regulators on that one. I think the concern was around having a market dominance and being able to shut other players out, because the buyer of that has such a significant marketplace that they can control who's competing with their own products. And I think that there is some sensitivity around that.
Okay, so 2024 overall, you think is going to be a pretty hot year for M&A. Can we say that?
We do. We think, again, 12 to 13% increase, which would be nice, because over the last 2 years, M&A has gone down 30 to 40%, depending on what sector you're looking at.
And M&A is not just for the big guys. You can have much smaller, even businesses you've never heard of, right?
Right. And we would, and
I mean, how does that work? How is that different in terms of funding or whatever than the big deals?
Well, the smaller deals are easy to get funded, and sometimes you can fund them off balance sheet. But you probably will see a pickup in some of those smaller deals, because quite frankly, they're also coming up with maturities on their debt that they're trying to figure out how to refinance. And often, again, it's the cost of capital is too expensive for them now. They struck these deals 5 years ago when the cost of capital was almost free, and now they're paying 5-6%. That's a very different economic scenario for them.
Is that one of the bigger drivers behind some of these deals, that we got a big debt coming up or whatever, and this is the way we can fund that?
It will be, for sure. They need to exit. They need to refinance that debt, and to increase that interest rate by 4 or 5% is significant.
What's going on with private equity?
Private equity.
Do we call it private equity anymore, though?
PE?
Do we still call it that? Because it's kind of morphed into something else.
If we change the name, we'd have to change a lot of thought leadership. So we'll continue to call it private equity. But they're in a difficult position right now, because, again, their deals are leveraged. They were, those that were struck 5 years ago, they were probably hoping to monetize by now, but they're coming up with the same maturity cliffs. And so they have to do the math to say, should we lower our valuations and try to sell these portcos now? Should we refinance, hope that we can get refinance for a lower cost of capital in a year or two, and keep the valuations high? You have to go portco by portco and really do the math to see what makes sense, whether you move now or hold on it.
Okay, the question everybody's been waiting for: how many dogs and what are their names?
So I have 5 dogs.
Oh my gosh!
They are. So we got Loot, Tiki, Greta, Berta, and Irma. Yes.
All right.
So if you want a dog, I can ship one over to you right away, because I have too many.
I will take any and all dog. I Googled. I didn't know what.
You don't even have a snow shovel yet.
The
You're
dog
already
can
getting a
stay
dog?
inside.
Good Lord. All right. We'll leave it there. Mitch Berlin, Vice Chair of America's Strategy and Transactions with Ernst & Young. I don't think he's ever going to come back with us for that.
The real question is, would you rather have a dog or a shovel? I'd rather have a dog.
How about you get a dog that you train to shovel you out or something like that?
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's take a deeper dive into these risk assets. Skyler Weinand is CIO at Regan Capital. Let's start you off with the bubble question. Does this feel like a bubble to you?
It sure does, with stocks back to all-time highs, short-end rates up 500 basis points in the last 2 years, long-end rates up 250 basis points. You do the math on where stocks should be, given that rise in rates, stocks theoretically should be down upwards of 40% over the last 2 years.
Wow.
So we're at it. You just took Bailey's breath away.
No. So what breaks then, Skyler? I'm just looking, we've got the swaps pricing in just under 6 rate cuts this year. We've got a lot of analysts and strategists talking up 2024 earnings and looking into 2025. what happens?
You have to look at leverage first, and the most levered players out there are going to break first. We've already seen that in banks. Then it goes to private equity and very leveraged companies. The last folks to lose will be the least levered companies that are using a half a turn or maybe over only a turn of leverage. So I think the market's going to be really bifurcated. You hear a lot of folks talk about, let's stick to high quality. I like that. But look to leverage to break before anything else.
All right, 2 questions then off that, Skyler. Going back to your initial point, are you shorting the market? And then are you shorting some of these levered stocks? How are you playing that?
I think, we're not stock guys, but in my stock investments, I think, it's one of two things. A, sometimes the only way to win is not to play and to wait it out and maybe stick in mid to high single digit income plays. But B, own the entire market as well, where I don't know when the next NVIDIA or Tesla or Monster Beverage is going to come along. So I want to own them all.
Who's most over leveraged? Is that the right phraseology?
Definitely banks. Banks are government-sponsored hedge funds, so to speak, allowed up to 12x leverage. Now, what's happened over the last
you're
years,
talking the majors or regionals or what? Or just the entire
all banks
industry?
Are allowed the same leverage, but regionals and community banks got a ton of cash in post-COVID, post-PPP, right? So folks got all this cash, they parked it at the banks. Banks sat there for 8 months. What are we going to do? Okay, let's go out and start buying treasuries and mortgage bonds. What's happened is a lot of those bonds are down upwards of 20 points, right? And so if you were levering that up 10 times, 12 times, your effective equity now went from 10% down to about 4%. So you're upwards of 25x leveraged. So what you have to look at is you have to look at tangible book value, tangible equity, right? And if that percentage is at only 4 or 5%, divide 4 into 100, that's 25x. So you're 25x levered. So moves like we've seen since the start of the year, the bond market's down a point and a quarter. Multiply that times 20 for a regional bank or a community bank that owns treasuries and mortgage bonds.
So who's least leveraged then on the opposite end of the spectrum?
JP Morgan, the big guys who had a lot of money, they took it in, they focused on fee-paying product like credit cards. They weren't immediately incentivized to go out and buy really, really long duration paper. And so on the flip side of the large guys, B of A, you'll see, has huge amounts of unrealized losses sitting on their balance sheet. JP Morgan looks like a genius because they didn't really go and invest in all of that money into Fannie 2.5 coupon paying mortgages, which 2 years ago, the market thought everybody was going to refinance. And something like 70% of all mortgages have been issued in the last 2 years. So now the market thinks nobody's ever going to refinance again. Nobody's ever going to move. Everybody's stuck in these 2.5% coupon mortgages. So it's who owns that stuff and who doesn't. And JP Morgan stuck really short duration. And now they're coming out ahead of everybody. The time to own money markets and T-bills, honestly, was when rates were 0, not when rates are at 5.25, 5.5.
Well, Skyler, we've talked a lot about what you don't like. What do you like?
So now there's two sides of the coin in terms of equities and in terms of real estate and most things. It's, do you want to be the equity holder or the lender? Now is a great time to be a lender, okay? And you can be a lender on real estate. You can be a lender to equities, i.e. bonds. You can be a lender to municipalities. So now is as good of a time as ever to lend. The market's been hoping, savers have been waiting for 5+% yields on high quality fixed income for 16 years now? And it's here. We should be jumping into this like Scrooge McDuck.
Okay. I've always been told you don't fight the Fed, but certainly the bond market has been fighting the Fed, or so it would seem. Your impression, got about a minute left.
Yeah. The market, the Fed has been saying for the last 2 years now,
but we haven't been listening.
There's going to be a lot of pain, right? And we've seen pain. Bond market was down 13% last year, came back the last 2 months of, 2022, came back the last 2 months of 2023 to make it a positive year. And the Fed is still saying rates are only going to drop 2 to 3 times this year. Yet the market has priced in 6 drops this year and 8 drops over the next 18 months. So it's a really good time to sit in floating rate paper that'll hugely benefit from the Fed, what's the Fed saying happening versus what the market is saying. If you're in fixed rate paper right now, what you're long is rates dropping 7, 8, 9 times over the next 18 months.
All right. We'll leave it there. Skyler Weinand, the CIO at Regan Capital.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
They always told me don't fight the Fed, but it looks like somebody's fighting the Fed. At least the bond market is. Will the markets and the Fed interact with how they're going to interact in 2024? Hans Olsen is CIO at Fiduciary Trust Company, joining us now, I think from Boston, to discuss. So the market, as I said, the bond market at least is fighting the Fed. Does this set us up for some kind of disaster now?
I do think that this market is certainly overbought and overconfident. And I think you see it, the overbought view when you look at sort of the S&P's RSI, right, the relative strength. It has had one heck of a run. And it's corrected a bit from that, but now it looks like it's making another run to a real overbought position. And the overconfident bit is really clearly seen when you look at the difference between what the market expects for rate cuts and what the Fed is telegraphing. And so far, the economy is suggesting that perhaps the Fed is more right than is the market.
We were talking about it this morning. What do you make of the University of Michigan sentiment data, and how does that kind of impact your view on the path forward for markets and also the Fed?
Yeah, that's a good question. I tend to focus on what people do versus what they say, and especially in markets, right? You follow the money, and without a doubt, I mean, it was a good read. I look back at what happened with retail sales in December, and that was pretty good. If you look at what's happening with employment, that's also quite good. So people, I think, are in pretty good rude economic health at the moment. Housing looks like it is going to be just fine, with the exception of today's numbers. But I think if you look forward with permits and the like, that all suggests that the economy is in rude health. So if that is the case, then one has to rethink sort of the timing and the extent of the interest rate cuts. And as you know, that 16% run in the end of 2023 was powered in large part by expectations around rates. It wasn't powered by earnings.
So we are headed for soft landing, no landing, hard landing, and which one of those scenarios do you think it's going to be, and what is that going to mean for risk assets?
Yeah, John, that's an interesting question, because if I had told you last year at this time that we would have interest rates where they were without some sort of resetting of economic activity, or certainly the market, we thought it'd be barking mad, but that's exactly what happened. So last year, in many respects, was a year of no landing, because we didn't hit the Fed's target, and the market was fine, and the economy was fine. I think in many respects, there's a good chance that this year is going to be a year of either a softish landing or indeed possibly no landing. maybe a go round, right? Where we don't hit that Fed target, the economy is actually stronger than people are giving it credit for right now, and the markets can do pretty well with that. I think, though, the way that you make money in that environment is different than the way that you made it last year. Returns last year were all driven by multiple expansion, and it really happened in Q4 on the belief of rate cuts. So really that powered it. And it was not assisted at all by earnings. This year, I think it has to be assisted by earnings. So, I'm not sure that we can expect much on the multiple expansion front. So this is the year where I think stock picking really starts to matter. A focus on profits is probably the way to go here. So, you get away from necessarily incredibly high valuations, but more to high quality, profitable companies being the prominent feature that people should be emphasizing in their equity portfolios this year.
Yeah, Hans, let's stick on that note in terms of what areas you do like. You mentioned profitability, maybe lower multiples. What areas, industries, or sectors are you liking for 2024 when it comes to the equity market?
Yeah, I think it's important because it'd be easy to talk sectors, but even within each sector, there are companies that have these features of what you would want this year. So, even some of the higher valued sectors, you would find companies that are incredibly profitable, really good allocation of capital, and which will drive some nice returns. I think from a sector standpoint at this juncture, software, banks, oil and gas, computers, those would be areas that we can see companies living in that have the features that we want. And you can see that if you drill down into companies like an ExxonMobil, a Berkshire, and NVIDIA and the like. These are companies that, they should have the wind at their back because the earnings are there and they're likely to grow. So I think that's how I would come at it, rather than just sort of do the passive S&P 500 exposure.
If we agree we're in a disinflationary environment, what does that do to earnings and sales?
Yeah, that's an interesting question because it's disinflationary to what, right? So if we went from 9 to 3, I think we've seen that largely play out. If it goes from 3 down to where it had been for the last 5 or 6 years, that'd be another case. But I don't think that that's going to happen. I think it's really going to be now about margins and earnings growth. And to the extent that your cost of goods sold has some mixture of fixed in it versus floating, right? So you're not as susceptible to your input costs rising as much if you've hedged some of your inputs and the like. You could actually, interestingly, see your earnings rise in an environment where there's a bit higher inflation. So the details will matter in an environment like this.
Hans, thanks a lot. I appreciate it. I was going to say snowy Boston, but not yet. It's on its way, Hans. I bet he has a shovel. Hans Olsen, CIO of Fiduciary Trust Company, joining us from Boston right now.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bubble or no bubble? That's kind of the question it raises for me. Brian Vendig is the president at MJP Advisors. He joins us now from, where are you, Connecticut?
Westbury, Connecticut, John.
Westbury. Oh, lovely. To discuss the outlook for the market. So what say you when I say, oh my gosh, maybe a bubble?
Well, I don't think that's necessarily true, John, when considering all parts of the market. I mean, when we look back at last year, we know that majority of the gains came from mega cap tech. And we did see a broadening out in the market in the fourth quarter. But really, when you look at areas like small cap stocks, some value-oriented sectors like healthcare and industrials, I really think there's some other parts of the market that, again, to the points that you and Bailey mentioned about, earnings growth, in 24, I think the market's going to come back to fundamentals, and we're looking at some earnings numbers over the balance of the year that can help those areas play a little bit of catch up, while at the same point in time, I still think there's that longer term trend with AI innovation that is going to play out in aspects of the technology sector.
Yeah, I wanted to ask, talking about the catch-up trade has been something I feel like has been top of mind since really the October bottom. Second best performer in the S&P 500 is NVIDIA, up 17%, obviously that coming after the TSM number. So when you look at that broadening, what areas are we going to see strength broadening out to, and what does that mean for the likes of an NVIDIA, which still seems to be red hot?
No, that's a great point, Bailey. I think on the NVIDIA side of the house, I'll just address that first. I mean, it's that expectation of growth moving forward. So when you look at the forward PE for NVIDIA, as much as the share price has had a nice run, the forward price to earnings ratio is actually quite reasonable, with a 20 handle or so. But when we talk about the other areas of the market, let's just be fair when we take a look at that disparity of return, going back to the S&P versus, let's say, the even weight S&P, for example. We know that a market cap S&P 40% is in those magnificent 7 names or so. And when we look at an even weight and we really strip that out, we see that the forward price to earnings ratio of the market is actually quite reasonable in some sectors under their historical average. So healthcare, small caps, mid cap stocks, looking at some areas in the industrial complex. I mean, these are things that we know that there's some breadth and some trends there, and the outlooks for growth are actually looking quite promising.
Okay, since you guys brought up AI, I got to ask, when does it start to gel in terms of the sales? Well, we've already seen that. You mentioned NVIDIA, but along with the productivity gains that are promised by this new technology. When does it all come together?
Yeah, no, I think it's all, that's a great question. It's almost like, when does it come together where we start to see, market expectations on rate cuts line up with reality from the Fed, right? So I think the AI trend is a 5 to 7 year trend. I mean, there's a high multiple of sales that's being put on a lot of these companies right now, which we are a little wary of, and you have to be selective. I think it's looking at it from that productivity point, which is why we like areas in technology that are focusing on workflow management, data management, thinking about how AI might create more productive outcomes when you think about cybersecurity, things of that nature, than just saying, hey, we're going to invest in a certain aspect of hardware that's probably going to be used because AI is going to be coming. I think it's a longer term trend. So will there be volatility in the space? Will there be the natural winners and losers kind of play out over the next 5 to 7 years? Yeah, we think so. But don't forget that, again, this is the point I'm trying to make, going back to Bailey's question, is don't forget about some of those other areas that have stable balance sheets, predictable cash flow, margins that look strong, and there's still innovation. And that's why I want to remind people about healthcare, because healthcare did not perform well last year, but it's one of those areas of the market where you're concerned about economic expansion this year, can be defensive, but we know there's a lot of innovation coming from healthcare companies as well that could be supportive for growth moving forward.
But where in healthcare do you particularly like? Are we talking biotech, med tech? That seems to be where innovation would be versus something like managed care?
Great point. I think to be selective in healthcare, we are looking at areas of some of the biotech, some of the big pharma space areas, because the big pharma companies, they're going out and acquiring other companies right now and building out their pipeline for new therapies and drugs. And I think as rates change, we might see a little bit more in that M&A space from healthcare. And I also think at the same point in time, we have a demographic shift that we know that is going to continue to play out in the United States. The baby boomers, they're not getting any younger. There's still demand for services and care that's out there. So even looking at some of the larger healthcare networks, healthcare providers, insurance providers, I know they've had a rough week this week when considering concerns around Medicare costs, but those that can execute and move through that, I think also are areas of healthcare that makes a lot of sense, Bailey.
Yeah, and I'm not a brown nose, but I got to point out the big boss's editorial today. The healthcare system, he writes, is more short-staffed than ever, even as it faces its next big shock, an aging population. So tackle that one from an investment perspective, since you brought up the healthcare industry.
Yeah, definitely. I mean, I think there's a concern around let's say, investing in, let's say, hospitals that are trying to run their staffs at certain margins, but we have a labor shortage and we also have issues in quality of care, which might suffer, which then that then causes demand shifts around that space. I'm focusing more on the ways to deliver the care and helping to support productivity, whether that might be software and technology in the healthcare space. Again, the insurance providers, helping to provide a wider network or better products or policies that people can take advantage of. So I'm not focused so much on the labor side. I'm looking more at the solution side to try to get through some of these problems, John.
All right, Brian, thanks a lot. We'll leave it there. President at MJP Advisors from lovely Westport. I think isn't that where Martha Stewart lives? Westport.
I'm not that demographic. I'm not going to.
You're from California.
Yeah, I'm a California kid.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.